Good afternoon, and thank you for joining me for this month's SURF monthly webinar. In today's session, I really want to review Q1, how the portfolios have held up in the very trying market environments that we have been in, and I will quickly touch on positioning and then some of the risk management and tactical changes that we have made in the portfolios. So in terms of the agenda, I'll start off with a summary of the investment strategy, followed by the portfolio structure, so a little bit more detail with regards to exactly where the portfolio is invested. Then we'll touch on economics and markets. As I mentioned, very eventful first quarter of the year. So what are some of the key events that we're paying attention to? Some of the concerns that we have with regards to what's going on in global markets. And then lastly, we'll have a look at how actually the portfolios have performed in the first quarter, as well as the longer term numbers relative to competitors, as well as relative to their own benchmarks. So just kicking off with the investment strategy of the Sygnia Umbrella Retirement Fund, it is a life stage model. We do believe that members are best taken care of when they follow an investment strategy that takes into account how far they are away from retirement from a risk perspective. This life stage model, which we'll have a look at over the next slide, does de-risk members the closer they get to retirement. And it's the structure of the life stage model starts de-risking from 6 years before retirement, but the underlying strategy is chosen by the employers. And employers can choose between one of 3 different investment philosophies, which I'll touch on the next slide as well. We do understand that as much as life stage models make sense for the majority of members, that some members may have their own unique circumstances and their own preferences, and for that reasons members can opt out of the default portfolios and they can create their own investment strategies. They have 18 different portfolios to choose from, no limitation with regards to how often or when they can switch, and also no switching fees. As I mentioned, the structure of the life stage model, whether you follow the Skeleton Signature or Synergy range, is exactly the same, starting to de-risk members from 6 years before retirement. So all the way up to 6 years before retirement, so very young members, right up until just 6 years before their normal retirement age, members will be defaulted into the 70 portfolios, and from then every year, from 6 years to 1 year before retirement, we will de-risk members by transitioning them slowly between the 70 portfolios. They'll then slowly go into a mixture between 70 and 60, then 60, and so on until 1 year before retirement, they're 100% invested in the Signature 40 portfolio. Now, the investment philosophies that employers can choose from is a fully passive low-cost option called the Skeleton range, the passive and active blend, which is the Signature range, or the active balance range, which is the Synergy range. There's a difference in terms of portfolio construction with regards to these 3 different ranges, and the Skeleton and the Signature range are constructed with what we call the specialist approach. The specialist approach really starts with asset allocation. So you start with the asset allocation, deciding how much you're going to certain asset classes, exactly what percentage should be invested in equities, what percentage in bonds, what percentage in cash. Once we've decided on the asset allocation, we then go and look for the best strategies to then implement on this asset allocation, and these strategies could be active or passive. So if you think about the Skeleton range, for example, we decide up front how much should be invested in equities, and this is not, of course, just a decision that is taken very lightly. There's a lot of research and a lot of data that goes into exactly how much we believe is appropriate to be invested in each of these asset classes. And these percentages are really informed by our forward-looking views on what asset classes will deliver over the longer term, and Once that's decided, we then decide, what index should we track for the equities. In the signature range, it will be what blend between active and passive, exactly which managers should manage the equity portion. In the bond space, we'll choose the best bond index or the best bond manager, or a blend between the two to manage the bond assets. The balanced approach, you don't start with the asset allocation, but you start with divvying up the fund between a number of asset managers. So you would give a portion to Allan Gray, for example, a portion to Coronation, a portion to 91, and then it's up to these underlying asset managers to then decide on the asset allocation. So Allan Gray will decide exactly what percentage they want to invest into equities, into bonds, into cash, into property, etc. So the asset allocation decision is outsourced to the actual single managers. This is just on the local side. The offshore portion of these, all three of these ranges is managed on a specialist basis, and it's exactly the same. So it's really just the difference on who has control over the asset allocation. In the specialist approach, which is Skeleton and Signature, Sygnia decides on the strategic asset allocation upfront, whereas in the balanced approach, we outsource that to the single asset managers. And looking at the risk and return profile of all of these portfolios that form the default, as you would expect, younger members that have a long-term time horizon would be, as we saw in the life stage model, defaulted to the 70 portfolios. And the 70 portfolios are higher risk in nature, but we do expect them to deliver higher returns over the long term. The investment theory tells us that if we do take on some investment risk, we will be rewarded for that risk over the longer term. So having about 70% invested in equities is higher risk in nature, but over the long term, we do expect equities to outperform inflation plus benchmarks and objectives, and deliver much higher returns. So the single manager portfolios, as well as the 70 portfolios, are higher risk in nature. They do take on more risk by having a higher exposure to risky asset classes, but they are expected to deliver a higher return over the longer term. The medium risk portfolios are your 60 and 50 portfolios, and then the lower risk portfolios are your 40 portfolios. And just a reminder of what the numbers in the names of the portfolios stand for. These really show us the approximate equity allocation. In the 40 portfolios, we expect 40% of the portfolio to be allocated towards equities, implying that the other 60 is in safer type of asset classes such as bonds and cash. And then there is an option for members to invest into the money market portfolio. That's the ultra low risk, not expected to provide very high returns at all over the long term, and not expected to beat inflation. So let's have a look then at the portfolio structure. As I mentioned, the strategic asset allocation is very, very important. It's not taken lightly. It's a lot of research and data goes into making that decision of exactly how much should be allocated to each asset class. In the Signature, Skeleton, and Synergy 40 portfolios, and Synergy is of course indicative only, as I mentioned, it's really the asset managers that control the asset allocation. But if you add up SA equities plus global equities, you will see that about 40% in total is allocated towards equities, with the rest of the portfolio being split against bond assets, income assets, money markets, etc. So this is the long-term asset allocation of the portfolios. You'll see that the 50, 60, and 70 portfolios do become more higher risk in nature, taking on more risk by investing higher percentages towards equities, and then lower percentages towards bonds and cash, the safer type of asset classes. The strategic asset allocation is the long-term asset allocation. Now, the world changes. There's constantly, news events, many opportunities in the markets. We know that markets go up and down all the time. And for that reason, we do practice tactical asset allocation on a daily basis. And tactical asset allocation means that we can tilt the portfolio. So this is what you're seeing on the slide now, is not the actual asset allocation at a point in time. This is what it's designed to be over the longer term. But at a point in time, we may sell some local equities, buy more global equities, go underweight and overweight certain asset classes. And this is for risk management, and to take advantage of opportunities in the markets. We do believe that we find ourselves in a low growth environment at the moment, both locally and globally. You've got a lot of debt all over the world, and the way that we believe that a portfolio should be constructed in this low return and low growth environment is in a core satellite approach. So looking at the core of the portfolio is where you have your more traditional asset classes. So it should be a very well diversified core. This core of the portfolio should make use of passive low-cost strategies in order to lower the overall cost of the portfolios. And then in addition to this core, we then make use of thematic satellites. And these thematic satellites are really there to provide the opportunity for outperformance. They are there to provide diversified and uncorrelated sources of returns. And the way we think about themes and what thematic investing really is being able to sit today and identify a theme that you believe will provide a lot of growth into the future. So taking you through this slide, if you look at the core of the portfolio, the pluses and minuses in front of the names of the asset classes show us our current positioning. So as I mentioned, the strategic assetification is the long-term assetification, but tactically we do change the positioning of the portfolio. So at the moment, the portfolios are sitting underweight South African equities, overweight South African bonds, overweight global equities, and underweight global bonds. For a long time, we actually didn't invest into global bonds at all, and now we've got a very, very small allocation in some global market bonds. Starting at the top, looking at the satellites, now we've got a little bit of an overweight into global real estate. Now, global real estate is a good alternative to global bonds, which we are very much underweight as an asset class. And that little plus in that satellite shows us the relative overweight relative to benchmark, which is the MSCI ACWI. Then looking, going clockwise, you'll see that the second satellite is disruptive technologies. Here we invest into the Fourth Industrial Revolution Fund. And again, it's about being able to identify a theme that we believe will add, good, sources of return and uncorrelated thematic growth to the portfolio. So the Fourth Industrial Revolution Fund invests into themes such as artificial intelligence, 3D printing, virtual reality, distributed ledger, clean energy, all of those, very exciting new technologies that we believe are at the forefront of the Fourth Industrial Revolution. And we've got a slight overweight to this thematic satellite as well. Moving on clockwise, you'll see emerging Asia, quite a number of little pluses there, showing you that we've got quite a big position in emerging markets, and specifically tilted towards the Asian economies. Now, we do believe that these economies are the ones that are set to grow the most over the next couple of years. Their middle class is growing a lot. There's a lot of innovation. If you look at the companies in those regions as well, and for that reason, we do have quite an overweight position to emerging markets, China and these Asian economies. Healthcare, developed market healthcare has been really good for the portfolio, has proven to be quite defensive, especially in this very volatile market environment, which we'll have a look at a little bit later as well. And in the health satellite, we've got some exposure to our healthcare ETF as well as the Health Innovation Fund. And then value. Value is an investment style that tends to do very well when you're in a rising interest rate environment. Now, we know that through, the COVID pandemic, governments across the world cut interest rates, and now we're starting to see interest rates being hiked in various regions around the globe, including the US and South Africa. So this is, broadly speaking, the portfolio positioning of the portfolios in a low growth environment. So having a look at more of the granular detail, you'll see that the signature range, as I mentioned a little bit earlier, is a blend between active and passive strategies. So in the equity space, you've got the Sygnia Swix tracker, which provides you the passive, low-cost exposure to a broad market index. And then as In addition to that, you're blending that passive exposure with some active managers that are able to provide that opportunity for outperformance. And these active managers are 91 Coronation and Visio, and you'll see that it says their equity transition portfolios. We were busy moving some money to another manager called Lorium. In the bond space, you've also got a blend between active and passive, where you've got the Coronation Strategic Bond Fund being the active portion, managing bonds on an active basis, and then the Sygnia Passive Bond Fund being the passive component. I'm not going to go through every single asset class detail, but I want you to have a look at the right-hand side, which shows you the breakdown of the offshore portion of the portfolio. And this is really where you're seeing the thematic investing play out. This is where you'll see the exposure to emerging markets, which is a satellite that we're quite overweight, the exposure to the fourth industrial revolution, the exposure to healthcare as a theme, the global property exposure. So this is really where you see the exposure to all of those very exciting thematic satellites. The skeleton range is the same from a strategic asset allocation and tactical asset allocation perspective, but where the difference comes in is that there's no active managers in the skeleton range. This is purely a low cost range, and you'll see that in each one of the building blocks, there is no exposure to active managers. You simply have these broad market indices. But on the offshore side, exactly the same, and you see that nice thematic investing playing out. Whereas the synergy range, this is where we outsource, the asset allocation decisions to these asset managers. It's a blend between some of the biggest and most successful asset managers in South Africa. So it's a blend between Allan Gray, Coronation 91, and Prudential, and it's really up to these asset managers to decide then how much they want to invest in equities, bonds, cash, all within the restraints of Regulation 28, of course. Before we look at performance, I do want to, now that we've covered the portfolio structure, and that the portfolios are invested across different asset classes, both locally and globally, let's have a look at some of the key events that have taken place in the first quarter before we have a look at how the portfolios have performed. Now, March, just like the other two, January and February of the year, has been very volatile. We can see that, across the board, if you look at the broad asset classes, pretty much everything is to the left, meaning that, we've had these negative returning asset classes with very few asset classes providing positive returns. If you look at the red blocks, that shows us the core equities. So equities across the board, whether it's local or global, unfortunately gave us negative returns for the month of March. If we look at the thematic satellites, now if you think back to that core satellite approach to portfolio construction that we follow, these growth themes that we believe will play out in the long term, just for the month of March, which is of course a very short time horizon to have a look at, did provide negative returns other than healthcare. As I mentioned, healthcare has proven to be quite defensive, and that provided a positive return for March. And then looking at the yellow bars, those are your more safe haven type of assets, and we can see that South African bonds, cash as well as gold provided positive returns, and then global bonds and US cash, of course, due to the exchange rate, have returned negative. So overall, March very volatile in the market, and we have seen that throughout the whole first quarter of this year. Global assets have been struggling, and we have seen a strong rand, which has negatively impacted the global portion of portfolios. But let's have a look at various regions around the globe and what has been top of mind for us in those regions. Now, looking at the US, inflation is really the largest concern in the US. Now, inflation has been very, very high due to, the supply chain bottlenecks coming out of COVID, and now it has been made even worse due to the war with Russia's invasion of Ukraine. Now, this war has resulted in higher oil as well as food prices, which has then put on additional upward pressure on prices and increased inflation even further. Now, the Federal Reserve did hike rates for the first time since 2018. And they say that they will, they're forecasting 7 interest rate hikes this year and 4 more next year. Now, we don't believe that this many hikes will actually take place, but it is important for them to almost talk up rates in order to contain inflation. And then if they manage to contain inflation somewhat, they maybe wouldn't need to have as many as 7 interest rate hikes this year. But inflation definitely has been really high in the US, and for that reason, they have already begun their interest rate hiking cycle. Now, we don't believe that we will see a recession. How central banks around the globe react to this high inflation and how they manage the interest rate hiking cycle really is key to whether we will see a recession or not. So we don't believe that we will see a recession, but we're definitely entering an environment of stagflation, which is the slowing growth and high inflation. Looking at the US, as I mentioned, we do practice tactical asset allocation. So, depending on the views of the current market environment, as well as, events around the globe, we do make tactical shifts and tilts to the portfolio in order to manage risk and in order to take opportunities in the market. And at the moment, we are underweight the US in favor of rather emerging markets. And we have even moved out of dollar cash and have rather invested into other currencies, as well as that small allocation to global bonds, which we haven't had in the portfolio for quite a while. The other thing that has been very much top of mind since the beginning of this year has been Russia's invasion of Ukraine. Now, with war, it's very difficult to, sit here today and say with certainty what the outcome will be or when this will end. We certainly have a little bit more clarity today than what we did on the 24th of February when Russia first invaded Ukraine. Now, President Zelensky has been, a leader that has been very much admired and respected for his, will not to give up. And he said a very powerful speech at the Grammys, where he asked for support in any way possible, but just not for silence. And the biggest impact that we have seen in markets anyway from this war has been its effect on inflation and the effect on oil and food prices. Now, as I mentioned, we do have a little bit more confidence or certainty today than what we did when the invasion first happened. When it first happened, there was a lot of uncertainty with regards to how strong Russia is, how quickly they could take control of certain regions, and of course the capital of Kyiv. Will they move on to other countries in the Eurozone if they take hold of Ukraine quite quickly? But I think what has been quite clear to date, which is 2 months later, is that Putin has been surprised at the strength of the Ukrainian resistance. It has been a lot more difficult for him to actually take control of certain regions than what he initially thought, and it's unlikely that this war now spills, beyond the Ukraine. However, he's also not going to stop before he declares victory of some sort, and that victory may be if he just takes control of a certain region, for example, that eastern region that can connect, Russia to Crimea. And that region close to the Black Sea, or it could be he could only stop after he takes a hold of the whole of Ukraine. It's very, very uncertain, but what we do know is that the longer that this war is drawn out, the greater the impact will be on food prices, on oil prices, and then of course on inflation, which in turn does affect growth. The next item that's quite important from a portfolio construction perspective is you saw that we do have quite a big overweight position to emerging markets, and the biggest portion of that emerging markets exposure is to China. Now, over the long term, China really does make sense from a growth perspective. If you think about this agenda of theirs for common prosperity for their people, it means that they want to continue to lift people, out of poverty and into the middle class, and they have lifted millions and millions of people over the last decade out of poverty into the middle class, and this is now only continuing. They're set to become the largest, consumer group by 2030, rivaling that of the Eurozone. Now, it's really the middle class that consumes, and a healthy, strong middle class and a healthy consumer does equate to positive GDP growth, and it is really positive for companies. But over the short term, they have experienced a lot of headwinds. So in this first quarter, we've seen COVID has resurged there, and they do have the zero COVID policy where they've been locking down, big city, mass testing of people. There was nervousness around this, support that was seen from China towards Russia, and, if they, really voiced it any further or did something more about it, there was possible US sanctions against them as well if they, really helped Russia in this current war that's ongoing. And then there's also been a lot of noise around the potential of delisting of some US companies from stock exchanges due to poor accounting. So all of these things really created the perfect storm, and China did reach its whatever it takes moment, where common prosperity and that agenda almost went on the back foot as a secondary kind of goal, and what was top of mind on the agenda was to actually stabilize markets. So, China did say that they will support markets, on the back of that, we then saw a really nice bounce back, which is what you can see on the chart on the right-hand side, especially in tech stocks in March. And over the long term, we still believe that, China really does make sense from an investment perspective, despite all of these short-term headwinds that we have been seeing there. At the moment, China is very cheap from a valuation perspective. So for that reason, we have topped up, and we have been topping up the exposure to China and emerging markets in general, ever since we've seen all of this volatility from about the second half of 2021 in the Chinese markets. But overall, quarter one actually was better than expected from a performance perspective. They've also lowered their interest rates, which will support growth going forward. So we're still comfortable despite the volatility and despite the risks. We're still comfortable with that overweight position to emerging markets. As you can appreciate, that position is just one part of an overall very well diversified portfolio across many themes, many regions, and many sectors. And then, of course, let's not forget that we do invest the bulk of retirement fund assets locally, if you look at the allocation to South African assets and South African bonds. And in South Africa, there's good and bad things for me to comment on. On the negative side, we have seen that unemployment has reached an all-time high on the back of poor growth. Now, the poor growth is no surprise, as we have had continuous disruptions to electricity. We, have seen that. We have all experienced the load shedding, and that does affect productivity, it does affect growth, it does affect profitability, and in turn affects, of course, unemployment. We also have seen interest rate hikes, which is not a surprise. It was very much expected. Every government around the world cut interest rates in order to support economies through the pandemic. And now that we're coming out of this COVID pandemic, we're seeing this interest rate hiking cycle. Although South Africa's inflation is nowhere near some of these global inflation figures that we are seeing, they are continuing to raise rates, which is not very positive for growth. But then on the good news side is that the rand has been very strong. It continues to benefit from commodity prices on the back of this war that we're seeing in Ukraine. Our stock market has done well relative to others, again, thanks to some of our commodity counters as well as our financial stocks doing very well. And then looking at South African bonds, if you compare them to other emerging market bonds, they really do provide some of the highest real yields in the world. All risks have been very well priced in, and they are a good place to invest, which is why we are overweight South African bonds. But on the equity side, due to these growth concerns, due to the instability of Eskom, we continue to hold the view that we should be underweight SA equities. And then something else that was very topical in the first quarter of this year is the announcement that we heard in the budget speech in February that retirement funds can now invest up to 45% offshore. So the previous Regulation 28 limit stated that investors can take 30% outside, or retirement funds can take 30% outside of South Africa with an additional 10% into Africa. That was then changed. In February, it was announced in the budget speech that it can now be 45% without a separate limit to Africa. So essentially, a retirement fund can take the full 45% into developed markets, for example. Now, we do view this very positively, as there's many good reasons why we believe that a retirement fund should hold global assets. Number one reason is diversification. If you look at South Africa, in the bigger scheme of things, it is a small, economy that makes up less than 4% of the emerging markets index and doesn't have any weight in, the world indices. From a growth perspective, as I mentioned, we do have a lot of headwinds. We're desperate for reforms, and growth is poor relative to some of the growth that you can find in regions outside of South Africa. And looking at, our stock exchange and our economy, it's a small with, very few, companies and sectors to choose from. So from a concentration perspective, you can diversify that a lot further by adding that allocation to global assets. And how much global you should have does depend on risk. We haven't changed our strategic asset allocation. So from a strategic perspective, we're still leaving that offshore portion at 28%. But from a tactical perspective, as I mentioned, from a risk management perspective, and to take advantage of opportunities, we do practice tactical asset allocation. What we have done is we have moved, your high risk portfolios, which is your 70 portfolios, to about a 53% global allocation. So nowhere near the limit of 45, we don't see ourselves going anywhere near the 45% limit in the near future. If anything, and if there's more good opportunities over the shorter term, we may see it go somewhere closer to 35%, but at the moment it's sitting at about 33%. So still very well diversified. South Africa, as much as we underweight South African equities, they are looking relatively attractive from a valuation perspective, and they have performed well. And of course, the rand has been strong. So now, having covered, exactly where the portfolios are invested, some of the, big events that we have seen around the globe, such as the war, such as this high inflation, this rising interest rate environment, and mentioning that we have tilted the portfolio, let's see, what this has resulted in from a performance perspective when we look at the shorter term as well as the longer term numbers. Firstly, looking at just market performance, there's a number of things that I want to point out if we look at, the broad market indices. Firstly, if you look at March and the 3-month number, very short term, especially in the retirement fund context, but you'll see that there's quite a bit of negatives. We do expect this, especially when we're sitting in an environment where the first quarter of this year has been, unfortunately, very eventful from a global markets perspective. But looking at the longer term, if you look at the 3, 5, as well as the 10-year numbers, you see nice positive returns out of these asset classes. Something I want to point out over the 1 year, there's a couple of discrepancies that I want to point out that will make sense when we're looking at the retirement fund surveys and, looking at performance in a little more of a granular detail. Is firstly the differences in return between the SWIX and the capped SWIX index. Now, these are both indices that measure South African equity performance. So the SWIX is the shareholder weighted index, and the capped SWIX just caps the exposure to certain companies. The capped SWIX was created due to the over-concentration risk that was a concern a number of years ago with regards to NASPers, and the capped SWIX used to cap the NASPers exposure at 10%. In August of 2021, we saw Prosus buying up a whole bunch of NASPER shares and essentially becoming bigger in the index and NASPers becoming smaller. And the JSE then said, well, they will cap both of these holdings, but it's no longer, if you consider their size, it's not appropriate to cap them each at 10%. What they'll rather do is the cap will now be 6%. So NASPers will be capped at 6% in the capped SWIX, and Prosus will be capped at 6% in the capped SWIX. So effectively, you've had a lower allocation to NASPers and Prosus together in the capped SWIX than what you have had in the SWIX over the last year. And as a result of these regulations that we have seen in China, specifically targeting tech stocks, gaming companies, the education sector, all of those regulations affected Tencent, which in turn affected NASPers and Prosus negatively. So this really is the reason for the big difference in performance over the 1 year. It has been as a result of the Chinese crackdown on tech stocks, which affected Tencent. So that's over the 1 year. If you look at the two indices now, there's hardly any difference between them. NASPers and Prosus are nowhere near the 6% cap. And in fact, the only thing that is capped in the capped SWIX at the moment is actually MTN. So we do understand where the underperformance came from over the 1 year. If you look at the 5-year and the 10-year numbers, you'll see that the SWIX has actually performed better. And then if you look at March, you can see that gap in performance closing. We do track the SWIX in the skeleton range of portfolios as well as the signature range. The portion that is invested passively is in the SWIX. So relative to other portfolios that may be benchmarking themselves or tracking the capped SWIX, there has been underperformance over this specific measurement period of 1 year. The other thing I want to point out is South African listed property, really coming off a low base. It has bounced back quite nicely over the 1 year, providing a much higher return than even South African equities, returning 27.1% for this 1 year period. If you look at the 3 and 5 year numbers, you'll see it's still negative returning. So we have avoided property in the portfolios. It has served us well over the long term, but specifically over the 1 year measurement period, if you compare these portfolios that don't have allocation to property to others that do have allocation to properties, we have in certain instances underperformed others that have had allocation to property. Bonds have done very, very well, giving us 12.4% for the year, much higher than cash at 3.9 as measured by the STEFI index. So this overweight position in global bonds has served the portfolios very well. We continue to hold this view. And the portfolios continue to be overweight South African bonds. And then on the global side, we've seen that developed markets gave us 9% in rand terms over the year, so much lower in absolute terms due to the rand strength over this period than when compared to the South African market, for example, and in emerging markets, largely driven by all of this, volatility we've seen in China, the regulations against tech stocks, now the latest with, the COVID restrictions and everything else that I've mentioned that has caused quite a bit of volatility in China. We have seen that emerging markets in general have struggled, delivering minus 12.3% in rand terms. And then global bonds, over the 1 year, negative returns. So we have been avoiding global bonds, which has been very positive for the portfolios. And we've only got a very, very small exposure now in some US bonds that are offering much more than what US cash is, which is the reason why we've, invested a very small allocation there. So having a look at then how these market returns then translate into the performance of your portfolios, I'm specifically going to focus on the 70 portfolios. If you look at, the total value of assets in the Sygnia Umbrella Retirement Fund, the bulk of the assets are invested in the 70 portfolios, showing us that members are actually following the default strategies and actually being defaulted into the life stage model. So focusing on the 70 portfolios, we can see that all three of them have done really nicely over the 1 year, delivering double-digit returns and ahead of their strategic benchmark of 9.5%. The Signature 70 portfolio gave us 13.1%, Skeleton 11.4%, and Synergy 14.1% for the year. If we look at the longer-term numbers over the 5 years, again, all three portfolios ahead of the strategic benchmark. And the Signature and Synergy giving us just over 10%, and the Skeleton, which is the low-cost option, just shy of 10% for the 5-year period. It's always nice to look at performance over the long term on a cumulative basis. So what this chart shows us is 100 Rand invested once into each of these portfolios, how that 100 Rand would have grown. And we can see that over the long term, all three of these portfolios have done very nicely against the global large manager watch median, which is the black line. We can also see that this growth hasn't happened without volatility. When you're investing 70% of the portfolios in equity markets, we know that equity markets go up and down, they are more volatile, but over the long term expected to deliver inflation-beating returns. The black line is the median performance of the managers listed at the bottom. And we can see that these are all very well established, experienced managers, and your portfolios, all these, 370 portfolios have done much better than the median performance of the managers at the bottom over the long term. Having a look at the surveys are with a 1 month lag. So these are as at the end of February 2022. We've actually just received the March surveys, but looking at performance over the longer term, 1 month doesn't really move the needle too much in terms of, positioning of the portfolio, especially when you start looking at, 5 years, 7 years, 10 years plus performance, which is exactly what we should be focusing on over the long term in a retirement fund context. With the 40 portfolios, we can see over the 6 month top performance from all of the portfolios. Over the 1 year, the Signature and Synergy 40 portfolios are basically second in line, pretty much at the top of the ranking tables, with the passive option a little bit further down. But over 3, 5, and 7 years, we can see top performance from all of these 40 portfolios. The 50 portfolios, again, over 6 months, Synergy has done very well, just a couple of basis points behind the best performer, followed by Signature and then the Skeleton 50 portfolios. Over the 1 year, the performance is further down on the rankings, but over the longer term, especially looking at 5, 7, and 10 years, we can see top performance out of the 50 portfolios. Looking at the 60 portfolios, not too different, where over the shorter term, especially looking at the 1 year, we can see that the performance is in the bottom half when compared to competitors, but over 3, 5, and 7, and 10 years, the performance has been the best relative to peers. And then looking at the 70 portfolios, which are arguably the most important portfolios, where the bulk of member assets are invested and where we expect members to spend the majority of their working lives, we can see that over the 6 months, Synergy and Signature are, right up there in the top half of best performers. Skeleton closer down to, the middle or bottom half of the good performers. Over 1 year, we can see that the portfolios are in the bottom half of good performers, and this really comes down to what I pointed out in the market return slides, the SWIX versus capped SWIX. So our portfolios have had exposure to the SWIX, so we've had that higher exposure to NASPers and process relative to some of the competitors. We have avoided property, which just over this 1-year measurement period has hurt the portfolios, but has served us well if you look over the longer term. So these really are the reasons for the underperformance over this 1-year period, but focusing on the longer term, which makes more sense in a retirement fund context, we can see that over 5, 7, and 10 years, we really have seen top performers from these portfolios over the long term. In fact, over 10 years, the Signature 70 portfolio has been the best performing portfolio out of all of these portfolios in the Alexander Forbes survey. Another thing to point out is that these are grosser fees. So on a net fee basis, the portfolios could look quite different. Some of these portfolios are very expensive, and some of these portfolios are very low cost, if you look at Skeleton, for example. So on a net fee basis, Skeleton would actually move further up as it is lower cost than some of these other very actively managed portfolios. And then comparing against the single managers, not really a fair comparison, but always interesting to have a look at the comparison nevertheless. We can see that value as an investment style has made a comeback, with Alan Gray being the best performer over 6 months. We can see that over the 1 year, a few asset managers have done better than these portfolios, but a few have underperformed. Over 3 years, it's only really Coronation at the top of the ranking tables. And over 5, 7, and 10 years, it's really only Coronation and 91 that really stand out as good, consistent managers. And these managers, of course, are included in the portfolio construction in Signature, as well as the Synergy lineup. And then the last slide I want to show you before I wrap up today's presentation is the risk and return scatter plot. Now, risk on the horizontal axis, return on the vertical axis. For every level of risk, you would want the best performing portfolio. So having a look at where these portfolios stack up on a risk and return perspective. If we look at the 40 portfolios taken on about 6% of risk, we can see that whether it's Signature, Synergy, or Skeleton, the 40 portfolios have been the best performing for that level of risk. Anyone plotting underneath that has taken on the same amount of risk, but if you look at their corresponding return on the y-axis, have not delivered as high of a return. The same can be said about all the 50 and 60 portfolios. For the level of risk that they take, they have been the best performing portfolios. And then looking at the 70 portfolios, if you look at where Skeleton, Signature, and Synergy 70 plot, we can see that there are some of the best performing portfolios for that level of risk, alongside Alan Gray, Alexander Forbes performer. But there are also many, many portfolios that plot underneath, which means that all of the portfolios underneath have taken on the same amounts of risk, not delivered as high of a return. And then the portfolios that actually plot to the right, so a lot of, these more green and blue dots, these portfolios have taken on more risk than the 70 portfolios, but have not delivered as high of a return over the 7-year measurement period. We should actually be looking at this risk and return scatter plot for 10 years or even longer. However, we chose to show you 7 years, as this is the time period where you have the most competitors in the space. You have to have a real and actual track record to be included in the surveys. And if you saw in the surveys, whenever we look at 10 years, there's less competitors in the space, as there's less portfolios that actually have had a real track record over the 10-year period. But as time goes on, as more and more of these portfolios show a track record, we will always show this for as long a period as possible. So overall, just to conclude today's presentations, yes, it has been quite a volatile time in the market and continues to be so. We continue to worry about inflation and the outcome of this war that we are seeing in Europe. We continue to be concerned about growth in South Africa. But on the positive side, the portfolios are very well diversified. We are practicing our tactical asset allocation and our risk management on an ongoing basis, taking advantage of opportunities, tilting the portfolios in a way that we believe makes sense for the current market environment. And we can see that it has proved well from a return perspective, and the portfolios have been some of the best performing portfolios in the industry over the long term. So I want to thank you very much for your time today. I see that there's no questions that have been left for me in the question and answer box, but if there's anything that you think of that you want clarity on after the meeting, please feel free to get in touch with us on email and I will get back to you. And this webinar will be saved. The recording will be saved if you want to refer back to it at a future date, and we save all of the recordings on our website. So thank you very much for your time, and we'll see you again in the next webinar.